My name is Neil Bloom, and I am the Tax Director at Cohen & Steers. I'd like to talk to you about the tax advantage nature of REIT dividends. Today, investors are faced with the triple challenge of finding income in a low-rate environment, protecting that income from taxes, especially as there's a new administration that may raise taxes, and protecting that principal in a potentially higher rate environment. REITs offer above-average dividend yields with tax advantages that are unavailable to broader equities. REITs are special under the tax rules in that provided they pay out all of their income, they pay no corporate income tax. And that's critical because most corporations pay double taxation. Once at the entity level on their income, and then again at the shareholder level when distributions are paid out to shareholders. REITs pay no income tax at the corporate level, and instead dividends, taxes are paid when distributions are paid to their shareholders. Additionally, the tax rules allow REITs to pay 3 different categories of income, all of which are tax advantaged. It's what I like to call the 3 flavors of tax efficiency. The first is ordinary income. And ordinary income is derived from REIT rental income and typically makes up about 60% of the REIT's distributions. Under current tax law, REIT ordinary income distributions are eligible for the 20% deduction as qualified business income, or QBI. Unlike qualified business income that people may earn from their businesses or their partnerships, REIT QBI is not subject to any type of income limitation and can be deducted regardless of how much income people make. Additionally, the deduction is available to people regardless of whether they itemize their taxes or take the standard deduction. It's a deduction for everybody. The second category of income that REITs pay out is capital gain distributions. Capital gains are derived when a REIT sells their property and distributes out those gains to shareholders. Capital gains are currently taxed at a maximum rate of 20%, with a portion being taxed at 25%. And finally, where a distribution isn't income and it isn't capital gains, it's return of capital. Return of capital isn't currently taxed. Instead, it's deferred, and then investors pay tax later on when they eventually sell their REIT shares at capital gain rates. And so I get a lot of questions from investors asking me, why do REITs pay out return of capital? Isn't that a bad thing? Aren't you really returning my money back to me? Is that sustainable? Well, if you think about return of capital in the context of a bond fund, where the underlying investments earn 5%, but the fund is paying 8%, that's true. You're really returning the investor principal to them. You're returning their money back. It's not sustainable. However, I want you to think differently about REIT return of capital. Typically, REIT policy is to distribute out the net operating income or their cash flow to investors. When calculating their taxable income, REITs are allowed to deduct depreciation based on the value of their real estate assets. Depreciation is a non-cash expense that reduces taxable income but has no effect on cash flow or the market value of their real estate assets. As a result, cash flow-based distributions are higher than taxable income. The difference is classified as return of capital. Tax concerns and low bond yields are driving demand for alternative sources of income. REITs offer above-average dividend yields with tax advantages that are unavailable to the broader equity market. Thank you, and I look forward to providing further updates about REIT securities in the future.